Dollar General just dropped a blockbuster of a quarter, and honestly, the numbers are pretty staggering. So how are they pulling this off in what's supposed to be a tough retail world? We're going to break down their latest results and see what's really going on. Let's just jump right in with the three big numbers that tell the whole story. All right, first up, a solid 4.6% growth in net sales. That's the top line number, right? It means the total amount of money coming into the company is growing at a really healthy clip. But that's just the start of the story. Now look at this. This is where things get really interesting. Their operating profit. That's the profit they make from their core business operations. It surged by 31.5%. This tells you they're not just selling more, they're becoming a much, much more profitable company.
And here it is. This is the number that makes investors really lean in. Diluted earnings per share, or EPS, skyrocketed by almost 44%. It's just a massive leap, and it's a huge signal of incredible financial health.
So those are the big three. And together, they paint a really clear picture, don't they? This was an exceptionally strong quarter for Dollar General, especially when you consider the tricky environment a lot of other retailers are facing.
The company's CEO, Todd Vasos, was quick to credit the team for just executing so well. You can see from his statement that it's all about serving their customers, and that focus is clearly translating into these powerful financial results.
Okay, so the headline numbers are impressive, for sure. But what do they actually mean for the business? Let's decode them, because they tell a fascinating story about what's working.
So net sales is our starting point. You can think of it as the grand total of every single thing that went through the cash register in every store, including the brand new ones. For this quarter, that number was huge, nearly $10.6 billion. It's the widest possible lens on their growth.
Now this next one, same-store sales, is super important for any retailer. It basically ignores all the new stores and asks a simple question: how are the existing stores doing? It's like taking the pulse of the core business to see if it's truly healthy.
And this chart really says it all. Last year, in the same quarter, same-store sales were up 1.3%. This year, that growth almost doubled to 2.5%. That's not just growth, that's accelerating growth, which is exactly what you want to see.
And that brings us to diluted EPS, the bottom line for anyone who owns the stock. It's the company's total profit sliced up for every single share out there. And Dollar General's EPS just jumped from 89 cents last year to $1.28 this year. I mean, that's that 43.8% increase we were talking about. Just incredible.
So, we've established that sales are up. But the real question is why? What's actually happening inside the stores to drive these numbers? Let's dig in. The answer is actually pretty simple. More people are walking through the doors. Customer traffic was up 2.5%. And what's really fascinating is that the average purchase size, how much each person spent, was basically flat. So this growth wasn't about people spending more money, it was about attracting more shoppers into the stores.
And what were all these new shoppers buying? Well, turns out, a little bit of everything. Sales grew in all four of their main categories. And it wasn't just the essentials, the consumables. People were also buying more seasonal items, more home goods, even more apparel. That's a sign of a really healthy, broad-based demand.
Growing sales is one thing, but turning those extra sales into even bigger profits, well, that's the real game changer. And this quarter, Dollar General absolutely nailed it. So the company's gross profit rate, which is just how much profit they make on the actual items they sell, jumped by over a full percentage point. Now, that might not sound like a lot, but in the thin margin world of retail, that is an absolutely massive improvement.
So how'd they pull that off? Well, it was a mix of a few smart moves. They earned higher markups on their inventory, and they did a better job controlling shrink. That's just the industry term for stuff that gets lost or stolen. And on top of that, they got way more efficient, cutting the amount of inventory they held in each store by over 8%.
After putting up numbers like these, it's really no surprise that the company is feeling pretty optimistic about what's to come. So let's take a look at their game plan.
And yep, here it is. Based on how well they've been doing, Dollar General officially raised its financial forecast for the rest of the year. They're basically telling Wall Street, hey, that strong performance, get used to it.
You can really see their confidence right here in the numbers. For net sales and same-store sales, they didn't just raise the forecast, they tightened the range. They're getting more precise. But the big one, again, is at earnings per share, which they bumped up significantly, now expecting it to land somewhere between $6.30 and $6.50 for the year.
And they are not slowing down one bit. They also laid out some seriously aggressive plans for opening and remodeling stores. For this year alone,
We're talking about almost 5,000 different projects, including nearly 600 brand new stores. And they're already planning almost that many for next year. This is a company still in full-on expansion mode.
So when you put it all together, it's pretty clear. Dollar General has found a powerful formula that's working right now, attracting more customers while also getting more profitable. And that leaves us with a big question. As it continues to expand into almost every corner of the country, is this value-focused model built to last, no matter what the economy decides to do next?